Learning Objective 12-7, prepare consolidated financial statements including a foreign subsidiary after remeasurement. So let's go do that. And we're just going to continue the same problem. Here's Peerless, and here's all the German numbers that we came up with. And here, in case you're wondering, here's just a little reminder about how to do it all. So I'm going to start off with my big elimination entry and debit income from subsidiary for $18,650. I'm also going to debit beginning retained earnings and credit dividends. I'm going to debit common stock of the sub. And the difference between all of these is going to go to the investment account. So $18,650 plus $12,000 minus $8,500 plus $4,800 would be a credit of $70,150. I'll make this a little smaller so you can see the whole thing. And then I have additional operating expenses of $600. I didn't show you the details, but this is amortization of the goodwill. Amortization of the patent. So it didn't go into the detail of this, but if you remember, there was a patent that we needed to write up way back when. There it is, $3,000 patent. And this time it's in dollars because the functional currency is a dollar. So 3,000 divided by 5 is going to be 600 additional operating expenses. And that would be a credit to income. And that would completely eliminate all this income. That's how they got $18,050. Again, I didn't show you the backup entries, but they're pretty, you would have to do that again. And one more, you got to write up your patent. Your patent would be 3,000 minus 3,000 times divided by 5 because it's amortized over 5 years, so it'd be 2,400. And that'll also be a credit to the investment account. And you've got your optional accumulated depreciation entry here for $6,000. And I think that's it. Excuse me. So you should know that I usually pause the video before I sneeze. These videos are a big production to make. And there you go. That would be your remeasurement consolidation. It's just a standard consolidation. And I hope I didn't confuse you by leaving out a lot of the details. They're all really review of things we've seen before. But if you need to see that, then you want to take a look at the book. It does pay to look one more time at what all the different exchange rates are in translation and remeasurement. And again, when we translate when the subsidiary is using its functional currency and the parent uses a different functional currency, and you're going to translate the subsidiary up to the parent's functional currency. With remeasurement, the subsidiary is not using its functional currency, so it needs to be remeasured into its functional currency. And then, if it happens to be that the subsidiary's functional currency is different from the parent's functional currency, then it will need to be translated also. And as I said before, translation and remeasurement is not like FIFO and LIFO, pick one. You may have situations where you do have to start off with a remeasurement and then translate. Now, when you're translating, the income statement is very easy. Revenues and expenses all go at weighted average exchange rates. With remeasurement, they're also going to go at weighted average exchange rates, except for items related to non-monetary items. Income statement items related to non-monetary assets and liabilities need to go at the historic exchange rate. The key ones are depreciation, amortization, and cost of goods sold. Now, the balance sheet will be broken up. Assets and liabilities will be broken into monetary and non-monetary accounts. Monetary accounts, for their translation or remeasurement, always go at the current exchange rate. Non-monetary accounts also go at the current exchange rate for translation, but for remeasurement, they go at the historical exchange rate. And stockholders' equity goes under historical exchange rate either way. Retained earnings needs to be rolled forward either way. Big differences down here with the exchange rate adjustments. When you translate, you translate the whole trial balance, and the difference, if it's a credit, it's a gain. If it's a debit, it's a loss. The difference goes to other comprehensive income. So specifically, it'll be other comprehensive income items, and then it'll get closed into accumulated OCI on the balance sheet as part of stockholders' equity. With remeasurement, any gain or loss is going to go to the income statement directly. Again, if it's a credit, it's a gain. If it's a debit, it's a loss. Easy enough to remember. And that's going to go to the income statement as a gain or loss to increase income. And it doesn't get to that favored OCI adjustment.